In the second part of the audit evidence gathering, we're looking at one more item. Okay, here we're looking at the audit testing, sampling procedures, and then analytical review. So as auditors, we can't do everything, so we sample. So which sample procedures would we need to use? How do we test? What analytical procedures do we perform? Right. Let's share the screen, then we'll move on. Then the next part will be where we look at the audit working papers. Okay. So the learning objectives here is to look at understanding the principle of evaluation of risk of material error or misstatements going undetected, and then explain the relationship between audit sampling, audit risk, and materiality. And then the nature of compliance or control testing and substantive testing. Now you understand what control testing is. And then we also looking at understand the various techniques of audit sampling, and then the use of sampling as a valid audit technique, including its limitations, and then understanding the use and application of analytical procedures. Right. Let's move on. For evidence, like we said, should be reliable, should be sufficient, should be of the right quality and quantity to support our audit opinion, right? Now, the quantity of evidence we have been told will be determined by the auditor's estimate of the audit risk. So, audit risk, including inherent risk. Remember we said audit risk is a function of what? Inherent risk, control risk, and detection risk, right? And their evaluation of management's response to assess business risk. And it's also determined by the approach to the audit. Are we going to rely on the company's internal controls, or is our work going to involve a significant amount of substantive testing? That will determine the kind of evidence we gather, right? Now, in gathering audit evidence, we can use a number of approaches. Inquire, talk to them, inspect, observe, okay? So we'll be looking at this one after the other. Confirmation, recalculation, reperformance, and analytical procedures. Now, you have to use a combination of these to corroborate your evidence. The combination of these is quite important, okay? Now, inquiry, ask questions, talk to the management, seek clarifications. Inspection, go for the source document and inspect them, vouch the purchase invoices, check vehicle registration, observe, like stock count, okay? So observation to determine if laid down procedures are being followed. Confirmation, send letters to customers, to banks, even to suppliers, for them to confirm in writing some account balances. Recomputation or computation. It could be reperformance, it could be recalculation. Do some payroll calculations and check if the amount of statutory deductions are correctly done. Or maybe do a reconciliation, bank reconciliation, reperform it to check whether they are doing the right thing. And then, of course, analytical reviews or analytical procedures, where you would want to look at relationship between financial and non-financial data. Ratio analysis comes in, benchmarking with prior years comes in handy. As a 530 audit sampling tells us that we can't audit everything. We can't, right? So the application of audit procedures to less than 100% of the items within a population of audit relevance such that all sampling units have a chance of being selected in order to provide the auditor with a reasonable basis on which to draw the conclusion about the entire population. So any sample you select should be representative of the population. So when you're designing your audit procedures, you should consider, as an auditor, consider the purpose of the audit procedure, consider the characteristics of the population from which you select your sample. Now, whatever sample you select should be representative of the population, so of a sufficient size, so that you reduce what we call sampling risk to an acceptably low level. Sampling risk in terms of, what do we mean by sampling risk? So you select a sample, you use it to draw conclusion, but the conclusion doesn't actually reflect the reality. when you want to project it on the population. Okay, so normally increasing the sample size will reduce your sampling risk. So why use audit sampling? We can't check 100% of the transactions, right? So it is not possible for us to do. It's not cost effective, so use sampling. Now, like I said, in some situations, you must check all the population, like director's remuneration or items which are very sensitive, or maybe things which pertain to fraud or cut-off procedures. You must check everything, regardless of the number. There are rules in sampling. Whichever sampling method you choose, there are some 4 rules. Each item must have an equal chance of being selected, no biasness. The sample must be taken from the entire population, not from outside. So we have what we call interpolation. Use the findings from the sample to draw conclusions for the population. The same population. The population must be homogeneous. They must have the same characteristics. So if you're dealing with sales invoices. Don't go and choose purchases invoices to mix up with sales invoices and test. No. The results cannot be used to assess a different population. In statistics, they will say extrapolation. So you use a sample and then you extrapolate it, you project it. Here, we don't want that. We don't want that. We want intra. It should be within. So the results you get cannot be used to assess a different population. Don't do that. It cannot happen. So test of raw material stocks, even though they are all inventories, cannot be applied to finished good inventory. They are all stocks. They are all inventory. They are all assets. Okay, they are all inventories. But whatever conclusions you draw, sample you pick from raw materials and use to draw conclusion on raw materials, don't project that one onto work in progress or onto finished goods. We don't allow that. Now, only the detection risk is what the auditor can control. Detection risk simply means the procedures that the auditor uses in detecting any risk of material misstatement. That is the only, so that risk, that's the risk, okay? So if your detection methods, your testing methods are not strong, you end up getting a high detection risk by the auditor. So the auditor can control that. It's difficult for the auditor to control inherent risk and control risks. Those ones are normally business pertaining. They pertain to the business, right? So if inherent risk and control risk are assessed to be high, then your detection risk must be reduced as low as possible so that your overall audit risk will be low. Because your audit risk combines, it's a function of the detection, control, and inherent risk. So if the two, and so the inherent and control risk are what we call the risk of material misstatement. If they are high, make sure your detection risk is low to draw them down, to pull the overall risk down, okay? So we can only achieve this by what? By increasing the sample size in our testing, okay? So like I said, sampling risk, because all items in the population are not examined when sampling, there's a risk that the conclusion drawn will be different from what would have reasonably been drawn had the entire population been examined. That is, the sample chosen might not be representative of the population as a whole. So sampling risk falls as sample sizes get larger. If you increase the sample size, the sampling risk drops. When is sampling not appropriate? Like I mentioned in passing, when the data is sensitive, do everything. No sampling. When the population do not have the same characteristic, they are not homogeneous, do everything. When all the balances, the figures are material, do everything. When the population is too small, such that if the population is just 12, why do you want to choose some? Do everything. Okay, do everything. When use a sampling approach, the auditor must assess the degree of inherent risk and control risk before deciding on the sampling approach. So the audit approach may be affected by what? The size of the client, the type of accounting system they use, how complex is it, the number of transactions running through the system, the past experience of the client. Okay, so you need all of these to tell which audit approach you need to use. In terms of sample selection, sample must be random, like we said, per the 4 rules of any sampling procedure. Random. Every item must have an equal chance of being selected. They must be homogeneous, okay? They must be representative of the population being selected, being tested. Protective, sample must be protective in relation to the audit risk. So what we mean, the sample you are choosing should be enough for us to be able to say that, yes, our audit risk has dropped down. So you don't choose, that's why biasness is not allowed. So you realize that randomness helps you and representativeness helps you to protect the sample that you are using to draw your final conclusions, to work out your work. Again, it must be unpredictable. Don't let the client predict what you're choosing. Now consider the objectives to be achieved. So the audit assertions, the management assertions to be tested. And then what is actually tested, assertions being tested. Again, establish that population is homogeneous, they got the same characteristics, okay? And identify sampling units. Are you going to use an invoice number or a particular amount? Okay. Now, let's look at some guidelines, let me put it that way, in terms of sample selection. From the outset, set out an error or deviation criteria. So maybe no authorization signature on a purchase order. Set out what constitutes an error. And then set the level of assurance required. 95% confidence, 99, 90. So still statistical metrics are being used, okay? Determine the level of tolerable misstatement. If this amount of error is seen, we will accept it. So we are prepared to live with this, accept it, to live with it. All right. Then set the tolerable rate of deviation. That when it gets to this level, we can't deal with it. We can't live with it. Now, is the sample intended to confirm specific controls? Is the sample intended to confirm specific transactions or balances? Is the sampling method appropriate? Are we using random sampling, stratified sampling? Name them. Systematics, random sampling, which one? Now, the consideration of the sample size, look at the population size to determine the sample size you are choosing. Look at the materiality of the population in terms of the overall audit opinion and of the sample in relation to the population. So materiality is important. The lower the materiality limit, the greater the sample size, right? Which is easy. And then the degree of precision. So you always want to put in a plus minus deviation so that, well, if it falls within plus minus 2%, let's allow it. If it goes outside of that, we may need to adjust the account. There are some number of statistical sampling and judgment sampling which you may want to use. Judgment sampling using your mind, statistical sampling is using a scientific method. I would always go for statistical sampling. Now, the auditor faces two problems with sampling. How many should I test? Which items should I test? Okay, so you can use personal judgment to make these decisions, but be careful. And because I am afraid to incorporate bias, I'll go for scientific, the statistical. So currently, increasingly, people use the statistical techniques in sample selection because they are scientific, they are precise, they are efficient, we can justify it, they are objective, they are random, they are representative. The client cannot predict it easily, they are legally defensible, protective. Now, statistical sampling is generally more applicable to larger clients with large number of transactions. Even smaller ones, you can use it. What is stratified sampling, for example, where stratification is used to reduce the degree of variation between items within a population and enables auditors to direct attention to those areas where there is a greater potential monetary error. So when we talk of stratified, using their strata, from the word strata, characteristics. So you see that these particular transactions have a particular characteristics. Stratified sampling, okay? So the effect of reducing the sample sizes, we are concerned about overstatement of errors and we want the largest monetary errors are likely to occur in the largest individual items. They may wish to stratify the population by value, by characteristics. So audit effort would then be directed to those items with the highest value. So strata, based on a particular characteristic. So you can use the value, materiality, okay? So take an example like this. Let's say value above 1 million, number of items there were 10. The value is 36 million. So I said, well, This is quite significant. Test size 10. Between 250 to 1 million, the items there are 150. But the value is 95 million. So I'm going to choose a test size of 50. Between 50,000 and 250,000, the number of items there are 1,000. The value overall is 93. I'm going to choose 50. So what is happening here? Auditors will test all the 10 material items which amount to what? 36, which are above 1 million. We'll test everything. Now, auditors will test what? The 50 out of the 150 where the transactions are up to 1. And they also test the remaining 50 out of the 1,000. Can you imagine that? 50 out of 1,000. Strike the percentage and see. But you see that it's because of the value structure. Then we have random sampling, where every item has the potential of being selected. And so it will be representative of the whole population. So select from a source of random number using a computer program usually, or a random number table from Excel. So auditor will attempt to give all items in the population a chance of being selected. Here it's difficult to avoid conscious bias and predictability, because tendency to favor items that appear to be easy to check could happen. Okay, could happen. Then we have what we call random systematic sample selection. You start with the first one being random, then you say the next 10th item. So maybe 1,000 items, the first random one will pick the second item. Then you say the next 10th item. So then it will be second plus 10th, the 12th item, plus 10, the 22nd item, plus 10, the 32nd item, continuously. Okay. So you divide the population by sample size, start with a random, and then you start. So if a population to be sampled is 600 items, and the sample size is 50, the sampling interval will be maybe 12. One of the first 12 items will be selected as a starting point random, and thereafter every 12 item, until you get your 50 sample size. And this is typically useful when sampling from a non-monetary population like goods dispatch notes. Value-weighted selection. So we also have what we call the value-weighted selection, where we use currency unit value rather than the items as the sampling population. So each individual item, currency unit, is given an equal chance of being selected. So for example, £1 is selected out of the first 2,000, and thereafter each 2,000 pound is selected. Each is selected, okay? The item which includes that pound is selected for examination. High value items have a greater chance of being selected, and we have MUS. So if you go to the Moodle site, you see MUS sample there. Monetary unit sampling is the most common type. You see an Excel example there. Block sampling. We also have what we call block sample. Choose all of them in blocks. Okay. So block sampling consists of selecting a number of adjacent transactions or items, all sales invoices in a particular week, and then you select them. So it can achieve a number of cost savings in audit time. There are two main advantages. The block selected may not be typical of the population, because sometimes in a particular week, the sales will not be that much. But in a particular week, it will be more, right? In order to minimize cost, it is likely that only relatively few blocks of items may be selected. So a few days transactions may be checked, which are not representative of the entire population. Now, results of the evaluation of the results. So this one just for knowledge purposes, okay? So you projection of errors to the population. So let's say out of a population of 20,000, errors of 84 pounds were discovered in a sample of 5,000. So the following projection could be made. So express the 84 as a percentage of what? 5,000, and then multiply it by the 20,000. So you might just think that, well, it's 336 errors that could occur. Now, set your error level. If the 336 is less than the tolerable error, maybe the tolerable error is plus minus 500. If it is that, then we accept it. But if it is more than, if the tolerable error is 300, then you can say, no, we need to perform additional procedures, or you ask them to adjust the account. Analytical procedures or reviews is where we study relationship between financial information, sometimes non-financial information. It helps us to predict a particular pattern in the organization's experience and then the relationship between financial and non-financial. So that's analytical review or procedures. Now, it is a form of substantive testing. We sometimes also use it in planning. So here you could see ratio analysis, statistical information coming in, and we use this to make a sense of the auditor's knowledge and sources of information. Now, like I said, you could use it as an initial planning tool. And we also use it as a substantive test and also as a final analytics, actually. So it can also provide a proof in total of the accuracy, reliability of the financial statements during the final year audit. 5 considerations to undertake when you're dealing with analytical procedures. You analyze relationships, right? You also compare actual with predicted, with comparatives from previous year, with comparative businesses, with industry averages. You then investigate the variations, any changes, and then obtain explanations from management on these variations which are occurring. Then evaluate the results in relation to other audit evidence. So the relationships you are doing could be horizontal analysis, vertical analysis, common sizing, trend analysis, okay? And then you could deal with the comparatives as well, comparing to yourself with last year, comparing to somebody, an industry player, a competitor, or industry metrics. And then whatever there are differences, ask questions. Evaluate those questions. There are limitations, okay? There must be reliable data for comparison, else you cannot do any analytical review. Consistency is not conclusive. The fact that sales has changed by 20% and then the industry has also grown by 20%, it's not conclusive. You may need additional information to corroborate that evidence. Now, good control procedures are usually necessary if we want to rely on analytical reviews. And material items should not be tested using analytical reviews only. Find corroborative evidence to support your work. Okay. From this part onwards are examples of tools that you could use. Okay. So this is a extract from supplier from working paper, which is a sample test of purchase invoices. Okay. Of delivery notes here, sample test of delivery notes. This is what I was mentioning, the relationship check testing, horizontal analysis, vertical analysis. You could do trend analysis, common sizing. Okay, so those are examples we could look at. All right, so you could engage with 2 examination questions on pages 201 to 202, questions on polyglot and Moncton. Very important to engage with these 2. All right, so that's it. You have some examples as well you would want to look at and then use that to prepare for whatever is ahead and to gain a very good understanding of the audit practice. All right, we'll go to the working papers in the next session. I'll see you soon and bye for now.